Welcome to CoreLogic's webinar on the Hedonic Indices rebuild. Thank you very much for tuning in. We're live at the moment. My name's Tim Lawless. I'm the Research Director for CoreLogic Asia Pacific. And this webinar will be focusing on, over the next, say, 30 minutes or so, on what are the changes we've made to our hedonic methodology, which went live on the 1st of September. What do some of the changes look like? And how do the changes compare the index outputs and the results to the previous hedonic index results? We'll be covering off on all that information, but of course we're also welcoming your questions. We understand that this is a very sophisticated methodology. A lot of people do have some questions around what actually is a hedonic index and how do we calculate value movements across Australia's most important asset class, residential housing, which we now value at about $7.3 trillion. So we look forward to your questions at the end of the webinar. Please keep in mind that you do have the opportunity to ask questions throughout. You'll see that facility within the webinar page, but we'll be addressing the questions once we get through the actual slide deck. This is being filmed, so at the end of this we will make the video footage available for you to pass on to your friends and to your colleagues. So we thought we'd start on what actually is a hedonic index, and a good place to, I suppose, commence from is, well, what does hedonic actually mean? All hedonic means is it's an index that is attribute-based. What we're doing with our hedonic home value index is we're measuring home values based on the attributes of individual properties. Essentially, we're valuing every property across the country on a daily basis based on its key attributes, its number of bedrooms, its bathrooms, the land area of the property, and of course the recent sales that have occurred around that property as well, which are used as a benchmark to estimate the value. Every property differs based on its attributes and the quality of those attributes. We also look at other things like when was the year built of the property to help us understand what the imputed value of those individual properties are going to be. So essentially, at the end of the day, when we're measuring value change in the housing market, what we're measuring is the overall value change across the whole portfolio of housing in Australia, not just those properties that have transacted over the most recent period. But of course, those recent sales are a very important input into the overall hedonic model itself. So what is a hedonic model and why do we use it? Well, one of the first things that comes to mind is the hedonic model avoids a lot of the compositional bias we see in other market measurements. Take a very simplistic measurement of the housing market, a simple median price, which is very compositionally affected. Say, for example, if we see more first home buyers in the marketplace, which probably is the case in New South Wales and Victoria at the moment with the new concessions that have become available for stamp duty for first home buyers. Or take, for example, the period back in 2009 when as a first home buyer you could get a $14,000 grant for buying an established home or a $21,000 grant for a new home. We saw first home buyers move from about 15% of the overall market to a little bit more than a third. Theoretically, with more first home buyers in a marketplace generally targeting lower price points, that could have a drag down effect on a simple median price. Because the hedonic index is looking at the valuations of properties across the entire portfolio, not just those properties that have transacted recently, we are avoiding that compositional bias introduced into, say, a simple median price measure. The hedonic index is also quality adjusted. I went through this as I talked about what does hedonic mean. The fact that we are looking at attributes of properties, its bedrooms and bathrooms and land area, how many car spaces does it have, when was the property built, what type of property is it? Is it a house or is it a unit? All of these components do affect the quality of the property, and of course the hedonic measurement aims to value those properties based on the quality of those dwellings. The index is very timely. We produce this index virtually in real time. We release it to the marketplace one day in arrears. Because this is a valuation methodology, it allows us to publish the index results in a very quick time frame. But of course, we're still seeing very high correlations with other indices that aren't as timely. Take the Australian Bureau of Statistics House Price Index, which is a stratified median series. As I'll point out a little bit later on in this presentation, the correlation between our hedonic index and that ABS series is almost perfect on an annual basis and generally above 90% on a quarterly basis. as well, except we're publishing this index 1 day in arrears. The index also aims to compensate for capital injections. We're trying to measure true capital gains here, not the effect of capital growth that could be introduced by spending money on a property, such as renovations or adding new components to a property. So when we do see the attributes of a property change within the portfolio, we make sure that on the next day, those properties that have a change in their attributes are revalued and also have a valuation for the current day, so we are ensuring we're looking at apples with apples. If we see a property that gets demolished, for example, that vanishes from our database, then that particular property will be removed from the portfolio entirely. Other changes of attributes where you see things like if a home is painted, or they get some landscaping done, or they get a new kitchen, something like that, they're the sort of renovations that we can't see, obviously. So smaller renovations like that don't have an impact on our reading of the market. But when we do see changes to the core attributes, like the bedrooms, bathrooms, land area, car spaces, and so forth, that's where we'll obviously revalue those properties based on the change of attributes. The index also attempts to overcome some of the issues associated with sampling in the Australian housing market. We all know that turnover in Australia, we generally see about 5% of properties turnover on an annual basis. So we're seeing about 95% of properties simply don't transact within a year. So having an index that's portfolio based, we are looking at the entire portfolio of housing to measure value changes, does help to overcome some of that illiquidity of the housing market. And finally, the new Hedonic Index is very much internationally endorsed. If you look at some of the papers that have come out of Eurostat recently and the endorsements from the Bank of International Settlements or the IMF, generally what they're looking at is endorsing a hedonic model for their pricing instruments, including CPI and housing measurements. So why doesn't everybody produce a hedonic index? I think one of the reasons why we don't see more data providers in Australia releasing a hedonic regression index, I've listed a few of, I suppose, some of the challenges here. The first one, of course, comes back to attributes. Governments in Australia don't release attributes on properties around Australia, so this information is very hard to get. We generate our attribute data from a lot of sources, a whole wide range of sources across Australia, of course, including listings, valuations. We impute attributes as well through a variety of processes. So having that attribute base for the vast majority of properties in Australia is an essential starting point for building a hedonic index. Secondly, we also see the timeliness of acquiring property data in Australia as one of the limitations that is preventing some other providers from producing this style of index. Some states provide their transactional data up to 3 months after the settlement date. Some states are very quick, or some territories are very quick as well. But to overcome that timeliness or that lag in receiving the full set of data from each of the state governments, we have very good relationships with the industry. We receive more than 60% of all sales data directly from the industry in a very timely manner, well before the government provides it to us across the individual states and territories. It is a very sophisticated methodology. So finding the people that have the qualifications and the academic requirements to produce a hedonic index is relatively rare in Australia, though we are now seeing universities and academics now starting to look more at hedonic methodologies, not just in the housing sector, but also in the non-housing sector as well. And finally, the processing time to produce a hedonic index, particularly across every single dwelling. There's nearly 10 million dwellings in Australia, and imputing the value in every single one of those dwellings on a daily or a monthly basis is incredibly computationally intensive. The old hedonic model, which we've just moved away from, for example, would take about 8 to 9 months to produce a monthly back series on the combined capitals index. As I'll talk about in just a moment, moving to a new scalable production environment has allowed us to get around the long processing times and the computationally intensive CPU time that our old index was experiencing. So what's new in our series? This is where we're starting to get into what we've changed. What are some of the improvements and the upgrades we've made to our hedonic model and the hedonic series itself compared to the previous hedonic model? Well, the first change we made was improving the sampling that feeds transactional data into the hedonic model. We made the first change around our sampling techniques about a year ago, where we improved the filtering of property data. The old hedonic index used a static filtering process where there was hard-coded price limitations, which progressively, particularly in markets that were moving quite quickly, we progressively saw more legitimate sales being excluded from the model because they fell outside of the prescribed pricing limits. Moving to a dynamic sampling technique now, where we exclude, or we have a two-phase sampling technique where we remove non-arm's length transactions where we can identify them. Then the second phase is we do a top and tail on that transactional set, limiting the top 2.5% and the bottom 2.5% of transactions, but on a dynamic basis, so we're not seeing step changes when the sampling technique is made. We've also made some changes to how we handle those properties with very long settlement periods in our data. Specifically, this relates to off-the-plan units, which quite often can have settlement periods upwards of 2 years. What we've found in our unit series was that those properties that have been sold off the plan, they have contract prices that are much more relevant to the sales period from when they contracted rather than the settlement period, which could be 2 years later. So we're not excluding those properties from our portfolio that have very long settlement periods, but we aren't factoring in the transactional data on those properties into the model until they resell. Thirdly, we're looking at dynamic stock weights now. By stock weights, this is how we calculate our combined dwellings index. So having a firm understanding of what's the split between houses and units across our housing markets. Previously in our old index, these stock weights were based on census data, which of course is only updated every 5 years. Our new model looks at balancing the portfolio of stock between houses and units on a monthly basis. So we have a much smoother and a much more accurate reflection of the split between houses and units, which will be reflected in our combined dwelling series to make sure that each one of those product types has an appropriate weighting within that particular index. Also, we've updated the geographic boundaries around our hedonic index. We're utilizing the ASGS 2016 official standardized boundaries from the Australian Bureau of Statistics. Previously, the old hedonic index was based on boundaries from 2006. So of course the ABS will be updating these boundaries every 5 years, and we will be updating our own boundaries that run these indices in line or in cycle with those updates from the Australian Bureau of Statistics. The key benefit of having boundaries that are aligned with the Australian standardized boundaries, Australian Bureau of Statistics standardized boundaries, is that you'll know that the regions we're reporting on for housing markets will line up perfectly with other data being published by formal or official statistical providers like the Australian Bureau of Statistics. So say labour market statistics, you'll know that the combined capital city boundaries or the capital city boundaries line up perfectly with the boundaries we're reporting on for housing markets as well. You'll find that in the past, some other providers use aggregations of postcodes, or they use non-standardized boundaries to describe the capital cities. So we believe it's very important to adhere to these formal geographic boundaries so we can compare apples with apples. And finally, the index production has moved to a scalable environment. We're producing or calculating the indices on a daily basis via the Amazon Web Services. So we can use the cloud, we can use the scalable environment there. So a time series that used to take us about 8 months to build, just across a combined capital cities measure, can now theoretically be done in a couple of hours. Generally, we take a day to produce the indices, but if we really wanted to produce a very long back series, say a bespoke series across some unique attributes, then we could produce a back series very quickly. Having a back series that's easily testable, of course, has been a great part of refining our new model and testing the new model. So being able to make tweaks to the model and then run the new back series to see how those tweaks have affected the outputs has been a real improvement in the overall testing regime of this indices. So the outcome of all this work that we've been undertaking for the past 12 months is, and as you'll see in the graphs I'm about to show you, is firstly, there's been a reduction in the volatility of the month-to-month and day-to-day measurements. And we've achieved this reduction in volatility without sacrificing any of the capital gain calculations. Over the long term, we can see that the total returns across each of the capital cities and the broader boundaries are broadly similar to between the old series and the new series. But of course, as you'll see as we bring up some comparison graphs, the volatility of the old series, we're seeing the new series really cutting through that quite nicely now. In addition, we're also publishing a longer back series. We're really utilizing and leveraging the large amount of data that CoreLogic has acquired over the past 5 to 6 years and producing a back series that now goes back to 1980 in most capital cities. Not every capital has data going back that far or every state back that far, but most of the majors will now commencing in 1980. Previously, the previous index would start at 1996. We're also looking at the new geographical boundaries, of course, and we also have a method now that aligns with best practice coming out of the European Union, and that's also endorsed by the BIS and the IMF. So let's have a look at some of the outputs now. And this is probably what most of you will be waiting for is, well, what does the new index look like and how does it compare with the previous series? So the first graph I'd like to share is the correlation with the Australian Bureau of Statistics House Price Index. So as I mentioned before, the ABS series is quite lagged. We see this data being published nearly a quarter in arrears. Okay, whereas the CoreLogic series is just 1 day in arrears. You can see I've got the three series here. The annual correlations are very close to 100% on each of these series, and the quarterly correlations are generally above 90%. So what we're seeing here is an index that's very highly correlated with the Australian Bureau of Statistics measure, which is a stratified median, but being produced in a much more timely manner. You can see both series are showing a slowdown in the housing market, particularly in Sydney. And if you followed our data on September 1st, last Friday, when we released this data, you would have seen that Sydney, for example, saw 0% growth over the month of August and only a 0.3% gain over the rolling 3 months. It's looking increasingly like we move through the peak phase of growth across the Australian housing market around October, November in 2016. And we've been seeing conditions cooling quite in a controlled manner since that time. If we start looking at the turning points in the marketplace, this was another really important benchmark for us to be measuring. As I mentioned before, we didn't want to reduce the volatility of the index by sacrificing the total return calculations or smoothing the index. In fact, there's been no smoothing to the new index. What we're seeing here is a more or a less volatile measure simply due to the tweaks to the hedonic model and the improved sampling techniques. So you can see compared to the old index, the new index is picking the turning points in the marketplace virtually at the same times. But you can see compared with the two trend lines there that we are seeing the new hedonic model is really cutting through some of the volatility we're seeing on the previous series. Let's have a look through the capital cities now, and we'll start with the combined capitals index, which of course is weighted based on stock levels. You can see I've got a rolling quarterly change graph here and a rolling annual change graph here, just plotting out the old hedonic version and the new series against each other. So the first thing you can see here is that the new series is cutting through the volatility quite nicely, particularly on the quarterly measure. You can see that very clearly. And on the annual measure, you can see that the conditions or the readings are very similar. Of course, we are starting to see that rolling annual change now just starting to move through its turning point. The peak rate of growth, and we've moved through late last year, and we are now starting to see the annual rate of capital gains just starting to turn a corner and reduce in quite a controlled manner. But if you look at the Sydney market, you can see the quarterly rate of return has gotten down very close to the zero level, 0.3% over the 3 months ending August. You can see once again that there's some volatility in the old series that is being improved on the new series. And on the rolling annual change on the right-hand side, you can see once again that the housing market in Sydney has moved through its peak phase of growth. The other thing you can see looking back through these time series cycles back to the 80s is how the marketplace responded to the last recession we had. Prior to the recession, of course, we're seeing very volatile financial and economic times. But you can see the very substantial rate of growth towards the late 80s, followed by more reasonably sedate conditions. Following that, you can see the boom of the 2000s through to 2003, and the weaker period after that, the strong growth conditions in 2006 and 7, the effect of the GFC, and then the effect of stimulus in 2009, then of course the subsequent downturn we saw between 2010 and early 2012, which takes us into the current growth cycle here. The Melbourne marketplace, the old series was more volatile than the Sydney series. As you can see here, quite a bit of movement in that underlying blue line, but we've really succeeded in improving the volatility across the Melbourne measure. As you can see on the quarterly indices, Melbourne's been much more resilient to a slowdown in the housing market. You can see that quite clearly in the quarterly growth rate, still above 1%, and we haven't seen the annual growth rate come down quite as much as what Sydney has. Also in Melbourne, we're seeing auction clearance rates holding firmer. We aren't seeing listing numbers rising anywhere near as substantially as what we've seen in Sydney. On our measure, there's only about 0.3% more properties being advertised for sale across Melbourne at the moment, compared with Sydney, where we've seen about a 16% uplift in total stock levels being advertised. The Brisbane housing market, not a great deal of difference between the two measures in terms of the overall capital gain measurements, but you can see that Brisbane has remained a relatively sedate market. We're still seeing dwelling values rising, but roughly in line with wages growth at around the 2 to 3% mark across Brisbane. We still think Brisbane has very solid fundamentals, a strong yield profile, improving population growth, a much healthier yield profile than the other capital cities, but certainly hasn't seen those strong fundamentals now flowing through into better capital gains just yet anyway, but I think Brisbane is probably a housing market to be watching. Then we look at the Perth marketplace. Perth obviously is a market that's been in a downturn since 2014. We've been seeing dwelling values falling roughly about 10% from the market peak through to the end of August. But as you can see on the rolling annual change graph on the right-hand side, the declines in Hobart are starting to lose a little bit of their magnitude, and we are seeing that trend rate of decline just getting a bit closer to the neutral mark. We're also seeing first home buyers come back into the marketplace across Western Australia. About 25% of all housing finance commitments are for first home buyers now across that market. And we're also seeing advertised listing numbers coming down, which might start to add a little bit of urgency for buyers into this marketplace and help to put a bit of upwards pressure on prices. But absolutely still a buyer's market across Perth and the broader area of Western Australia. So there's some indications of what the old versus the new series looks like on both a quarterly and an annual basis. We're also seeing the trends across the marketplace are very different. This is a summary of what our rolling annual change looks like across each of the capital cities in Australia. You can see the trends are very different from the markets in decline, like Perth and Darwin, to the markets that have been very strong. In Sydney and Melbourne, where a bit of heat's now coming out of the marketplace, or those markets where we are seeing some momentum gathering, like Hobart and Canberra, and those markets that are relatively showing moderate growth, like Adelaide and Brisbane. Of course, we produce indices across the broad regional markets as well. You'll see that in our monthly deliveries. We also produce hedonic indices down to the SA2 levels. So if anyone's familiar with the Australian geographic boundaries, they start national, move through the states and the combined capitals and regional markets, and then start drilling down through the SA4, SA3 and SA2 regions, all of which we're producing hedonic indices on across all of those markets. So where to from here? Well, we've already released the first live set of data that happened on the 1st of September, and we'll be continuing to release our hedonic indices data on the first working day of every month. You can continue to download the back series of the daily indices from CoreLogic's website, as well as from the ASX website as well. You can also jump on our website at corelogic.com.au, click on the indices tab, and you'll see that there's a variety of Q&As and white papers, as well as the audit results from KPMG on that website as well, which are free for people to be perusing. The white paper on the methodology is very detailed. Okay, it is quite a sophisticated document, so it's probably not everybody's cup of tea. But if anybody who is interested in actually understanding the maths behind the hedonic index, I'd strongly recommend that you have a look through that white paper. So on that note, guys, I think we're at the end of the presentation. I know there's probably been a few questions coming through from people viewing online. I'd like to open up the floor now. I'm joined by a couple of my colleagues, from Kevin Ward, who's the lead data scientist on our index rebuild, and Fabian Huard, who's also one of our head data scientists who's been heavily involved in the rebuild of our hedonic indices. So we might flick over to answering some questions now. The first question we're getting on the marketplace is, how do we use the hedonic index in the residential marketplace?
So essentially, a hedonic index is a portfolio tracking tool, and as Tim pointed out in his presentation, what we do essentially is we value all of the housing stock that we have for every region in Australia, and in terms of how we kind of use it, we just really typically measure the change in the valuations of each property that we're valuing.
Mm-hmm. What that means, Stan, is that the index in the end is just an arbitrary number that tracks the price of the average house of, let's say, Sydney, for instance. So if the index goes up in a day by 1%, it means that we expect the average house in Sydney to go up in value by 1%.
Just another quick point there is we do work a lot with the banking and finance sector, of course, and this new hedonic methodology has the ability to create bespoke or customized indices in quite a straightforward manner. So for example, if we have one of our clients that's looking to understand what's happening across their high-risk postcodes they've allocated, and are those high-risk postcodes performing at a level even with the benchmark capital cities index, or are they underperforming or overperforming, we can very easily produce an index across those customized or bespoke boundaries. Interestingly enough, we can start producing an index across some of the coastal markets of Australia, which are very strong now. Essentially, we can build an index based on any attribute or geographical combination that anybody has an interest in, and thanks to the cloud services, we can produce that back series very quickly. So the second question is, do you incorporate off-the-plan sales in the new hedonic index?
So in the regression model, we don't actually include the sales prices. So typically, we've actually viewed off-the-plan sales not to be representative of normal price conditions. So essentially, what we do is we identify off-the-plan sales by long settlements. So if whenever we become aware of a sale that the contract date was more than 12 months ago, we exclude it from our regression analysis. That's not to say that we exclude those properties from our valuations, because we do, once we become aware of those properties, we do value them based on the existing sales that have happened for that region. We do have a new variable in our model, which is the prior sale. And for those off-the-plan apartments, we do actually capture the previous sale whenever we're valuing those properties. So if that property is ever resold, we do capture the change in the value of that property.
Mm-hmm. I guess our index is also aiming at tracking the performance of the existing stock, so we're quite comfortable in excluding those off-the-plan sales. We take the view that they actually represent a derivative contract that should basically price the risk of both buyers and sellers of defaulting on one side or not delivering the property to the market. So we think they actually not really align with the same characteristics of the existing stock on the market.
So next question. The methodology suggests you're asking prices in your new index. The next question, let me ask that question again. Your methodology suggests you are using asking prices in your new index. Is this correct?
In the hedonic value index, we don't include listings data. So we only use observed sales for a given region. We do, however, we also have hedonic indexes based on listed prices as well. So we do have that, which complements our existing value-based index, but we don't include listings in our hedonic value index. We do use sales information only, and we have a variety of sources that enable us to do that. And also we capture recent agent advice data in order for us to capture that recent timely price signal information.
Mm-hmm.
I should have mentioned as well, even though I'm talking about our hedonic valuation index throughout this presentation, CoreLogic does produce the entire suite of indices, starting from simple medians and means, through to trim means, repeat sales indices, stratified medians, and a hedonic series. The hedonic series we produce, we have a hedonic listings index, as what the previous question asked, and hedonic valuations index, but also hedonic rental indices and derived yield series, as well as an accumulation index, which calculates the capital gain as well as the total annual returns as well. So the next question comes from Jennifer. What are the differences between the current AVM model you used compared to commercial AVMs that are available in the marketplace? An AVM, for anybody who doesn't know listening, is an automated valuation model, which is another one of CoreLogic's core products.
Well, I guess they will be serving two different purposes. The commercial AVMs are aiming at giving you the best valuation at a point in time of your property, Jennifer, whereas the valuation used in the index are just designed to reflect the effect of passing time over the price of your property. So to give you an example, if you're adding a bedroom in your property, the commercial AVM will want to be in a position to reflect that to give you the better price, the more accurate price of your property. Whereas the AVM that is used in the index is actually going to control for any form of capital injection to make sure that the growth we reflect is only an organic growth, appreciation of capital, basically, as opposed to capital injection due to renovation or new stock coming to the market.
Okay, Helena is asking if there will be an index at the postcode level. I can probably answer that. At the moment, we don't have a hedonic index at the postcode level. We produce a lot of other metrics at the postcode level, including median prices and median valuations. Generally, our go-to at, say, a suburb or a postcode level would be a median values index, which is based on the median of the AVMs in that particular area. So I'm not saying we can't produce a hedonic index at the postcode level, but it's not something that's currently in our stable of products. The next question, also from Helena, was when is the starting point of the index as 0? Is the index quarter on quarter?
So we have produced these indices back to the 1980s, but effectively we've actually rebased our index to be a value of 100 much later. So that's in 2010, I believe. But we have a base date and a base value of 100. So our day 0 essentially is 1980.
So keeping in mind, that's just the index base. So the index values themselves don't have a great deal of meaning. It's the percentage change in the index values from period to period that's of the most value in this methodology. Going forward, and you would have seen this on the 1st of September when we went live, is we're also publishing the median valuation rather than the median price across each of our measures. So the median valuation is, I suppose, the best way to gain some relativity of, well, what does a 5% change or plus or minus change mean? In dollar values, well, we can apply that to the median valuation. The comment from Paul. In 2016 for Sydney, the old hedonic index had an annual change of about 10%. The new index has this bottoming out at about 2%. Do you know of any specific drivers behind this significant change?
So I guess over the long term, we do find a very broad correlation between our new model and our old model. So we have observed that in our new model that the rate of return for that period really closely matches the ABS readings. One factor that does drive some of those differences from time to time are things like the geographies used. For example, the old model it defines the capital cities using the ASGC convention, and we identified a number of SDs at the time, SSDs at the time, which comprised Sydney. Now, of course, since then, Sydney has expanded, and we use a different geographic classification system, which is the ABS ASGS convention, which was rolled out in 2016. So we have observed some portfolio shifts as a result. So I guess it's not always an apples for apples comparison with some of these regions. That was one factor. The other reason for the difference is is the outlier tuning. So we do have a daily re-estimation of where those outliers are. And we also perform the statistical regressions at the SA3 level. And that is something which is also a bit different to what was done before, which was at the SD level, or SSD level, I should say. As we do see a lot of differences in the regression sample, which has actually contributed to those observed growth rate differences from time to time.
Okay, the next question is from Frank. Why did you update the geographies?
So this is really to align with the ABS geographies. The old model used the geographies that were defined in 2006. Of course, that was 2 census periods ago. So we thought it sought fit to align to the new geographies and also take account of some of the expansion that may have been observed in some of the capital cities. Also, as well, the statistical regions have changed as well. We align to the SA3 in terms of our statistical regression, and of course an SA3 is comprised of a number of mesh blocks. So that statistical way of identifying regions that are similar has also changed in the last 10 years. So we thought that we would align to that method to be consistent with some of the official statistics.
So the other reason there as well, of course, is we want to make sure that the housing data we're publishing, that the regions we're reporting on line up with other published measures as well, coming out of the Australian Bureau of Statistics or through other government departments. So all those government departments, they do utilise these formalised, standardised geographies. So every 5 years, as they're updated, we're intending on updating the geographic boundaries and producing a back series when those new boundaries become available. So the next question is from Sarah. Why did you choose a dynamic stock weight approach and not census weights? Well, the easy answer there is you'll find the census weights are only updated every 5 years. In a period where Australia is densifying faster than what we've ever seen it happen, it's about 152,000 units currently under construction across Australia. We need to make sure that the combined dwellings index is appropriately weighted to reflect those changes in the types of dwelling stock. So if we only updated the weightings every 5 years, you'd find that each 5 years there's going to be a very bulky change to the actual outputs for that combined dwellings measure. We felt it was very much a better idea to be ensuring that the combined dwellings measure is accurately reflecting the mix of houses with units in as timely a manner as possible. So the next question from Louis was, what percentage of the index day-to-day results is influenced by hedonic versus sales transactions? And is this a constant weight or influence?
I think I think it changes. It depends on the region and it depends on the time of sale. So I think there are probably a multitude of factors that affect the perceived value of a particular attribute. For example, a bedroom, its value. A second bedroom could change in value from time to time, depending on what's happening at that point in time. So we have observed some changes in those values of individual characteristics. So I don't think they are constant.
They're not constant. As a matter of fact, we do recalibrate that every day, and they can also be detrimental. The case, for instance, of swimming pool, where we've seen in some region, in a specific time frame, a swimming pool could be detrimental to the overall price of the property. So that is something that the current model is reflecting.
That's about it for the questions that have come through. We might just give it a couple of seconds to see if there's any other questions that would like to be submitted via the facility on the webinar. But if nothing else comes through, we'd like to take this opportunity to say thank you very much for tuning in. It's always a surprise to me to see so many people. We had nearly 300 registered people for this webinar that are interested in a mathematical model, but I think it really does reflect how important the housing market is and how much interest there is in the housing market. Of course, we see about 52% of household wealth in Australia is tied up in housing. I mentioned a bit earlier, it's a $7.3 trillion asset class, so it really should come as no surprise to me that there has been so much interest. If you'd like to find out more about our hedonic indices, of course, you can see those white papers and the Q&A and the audit results on our website. We update our information. The daily index, of course, is visible and is available for download. But of course, we're producing different content virtually on a daily basis, from our research notes and our newsletters. Everything's available at the CoreLogic website at www.corelogic.com.au. Thank you very much.
Thank you.